right, we're going to go ahead and get started for today. Welcome to day 3 of the 2023 Higher Education CFO Forum here at Sikich. We're excited to have you back for the third day. Have a great lineup of speakers for you this morning. Finish up our day 3 of our forum here. As always, as we have the last few days here, please make sure to update your nameplate to reflect your first name, last name, and your institution. And please direct all questions to Sikich admin Megan. Questions will then get routed to the appropriate speaker as time permits throughout today's session. Next slide, please. My name is Anthony Cervini, partner in charge of government services at Sikich. I'll be serving as a moderator again for today's sessions. Next slide. Our agenda for today, we're going to start off with Kevin Bong and Ken Squires. We're going to share some war stories and lessons learned from higher education security breaches. We'll take a break after our first session, come back with 3 of our tax experts talking on unrelated business income rules, practical application, and common scenarios. And then we'll adjourn at 12 Central for that. As we have the last couple of days, please make sure to keep an eye on your email for the daily survey from Prolera. Completion of that daily survey is necessary for your continuing professional education credits. Our final slide here before I pass things over to our presenters for this morning, just our About Sikich slide here. Again, we have a wealth of services at Sikich that we're able to offer here. Our cybersecurity team today is going to share some of their expertise, and then our tax folks as well. So again, just give you a second here to glance at all the things that we can do here at Sikich for you. Also, a wealth of information that Megan's putting in the chat for you in terms of where you can find today's slides and information that are needed for today's sessions. But without any further ado, I'd like to pass things off to Kevin Bong and Ken Squires. All yours, guys.
Thanks, Anthony.
Thank you.
Hi, everybody. This is Kevin Bong. We're going to be talking about some war stories here at Sikich that we've done in cybersecurity breaches, and talk about lessons learned and how to keep your institution from experiencing that type of situation. Like I said, I'm Kevin Bong. I direct kind of half of our cybersecurity services team here, the half that does ethical hacking, computer incident response, and vulnerability scanning and things like that. Ken, if you want to introduce yourself.
Yeah, my name's Ken Squires, and I direct our governance, risk, and compliance team. Anything and everything from building information security programs, incident response plans, policies, and just working on compliance and identifying risk for our clients and helping them mitigate those risks. So glad to be here today.
Thanks, Ken. Here's a quick disclaimer. I'll just leave this on the screen for a second or two. You guys can glance over that. And with that, I'll let Ken give some background to our cybersecurity services.
Yeah, between me and Kevin here for cybersecurity, there's a lot of offerings that we do. These are some of our key ones. On Kevin's team, he handles a lot of the forensics and investigations. So anytime there's a breach, ransomware, or anything like that within organizations, they contact Sikich here, and we can help with that kind of forensics and investigation, looking at logs and access and those types of things to help kind of see what the root cause was of the incident, and then also, was there any data breached or anything like that. We do have an improved vulnerability scanning solution for PCI, which that we could use for our clients to identify any kind of vulnerabilities within systems and information assets that are out there, and set you up with vulnerability scanning. My team here, we do a lot of compliance and risk assessments, identifying those gaps and providing remediation plans, and helping build those strategic roadmaps so clients can build a mature cybersecurity programs. Pen testing, penetration testing is, one of those kind of validation things. We could say that we have these controls in place, but the penetration testing lets, some of our ethical hackers go in, and are there things that we could compromise, and what would be the things that you would want to put in place to safeguard from those. IT audits, just general controls reviews, making sure IT, the current IT architecture and solutions and assets that are in place are meeting industry standards. And then, like I said, helping build those strategic roadmaps from a remediation standpoint from all of these, and providing that kind of security awareness training afterwards, after we see these. So a wide range of services that our teams perform here.
Thanks, Ken. And yeah, kind of a cool accreditation we have. Sikich was one of only about 12 firms in the United States certified by the major credit card brands to do credit card breach investigations. So we get to do some pretty cool investigations, and we'll share some of the things we've learned from those here today. So the first thing I want to talk about is how 2021 and 2022 were different. You know, we've had this long history of the same things, viruses and passwords and things like that. But the last couple years, there's been some things that were different that caused some additional issues for a lot of folks. The first one here, we saw a glut of unpatched vulnerabilities in firewall and VPN devices. You know, we worked with, example, a client who had a ransomware breach, and we went and looked, and like there were people logging into their VPN on their firewall, like left and right. And so we ran a vulnerability scan against their firewall, and the scanner just popped up like, hey, your firewall is vulnerable. Here's some information we were able to pull from it. And it was like a dump of usernames and passwords pulled from memory of the firewall just by scanning it from the internet, because they hadn't patched this firewall in like 2 or 3 years. And you know, I've got a bunch of different little screenshots here, but all kinds of vendors had vulnerabilities like that in the last couple of years. And people don't always think to patch their firewall as regularly as they patch their Windows operating system or their browser or something like that. So that caused a jump. We've had more vulnerabilities, exploitable vulnerabilities in very common and somewhat mature software like Microsoft Exchange. Has been a problem in the last couple of years, where the exploit code for this vulnerability was being used out in the wild in 2021 before anybody knew about it, before patches were available. And we were seeing on-premise Exchange servers that were breached early in the year in 2021. And then the attackers just left them there and came back late in 2021, like at the end of the year, and started actually doing breaches, you know, making use of them, trying to do a ransomware attack or something like that. So just stepped up in terms of these kind of vendor type vulnerabilities. Another one was Log4j. You may have seen that one in the news last year, but that was a lot about kind of supply chain. So Log4j is not an application by itself. It's a code library used in other applications. So any application that used this code library was potentially vulnerable. And it was a really interesting vulnerability. You didn't trigger the exploit or trigger the vulnerability, break into the system by like hacking some service. You just had to get your payload in log data, because Log4j was a log data processor. And if it saw a certain code in that log data, you'd exploit the system. So really interesting kind of sourcing for that one and the ways it was attacked, and just a really broad impact of it. So we're seeing a lot of that kind of, again, even though we've been doing computer programs and security for so many years, we're still seeing mature applications with these critical vulnerabilities.
Yeah, you had mentioned something there real quick, Kevin, with the vendor, right? So if you look at some of those slides in the past, those are some big names on there. And I think, you know, it kind of comes down to our vendor selection and vendor management. We have put off kind of the big name companies like Cisco and Palo Alto as saying, hey, they're big companies, they should have security programs in place, and we really don't need to do our due diligence on those types of vendors. And the reality is, you know, we should be kind of, you know, checking to make sure that they're, you know, scanning those devices and assets and making sure they are up to industry standards. Even though they're a big name company, like we saw in those slides there, you can see some of the big name companies have been hit, SolarWinds and Cisco, and that we've been relying on over the last few years for their security, but really building kind of a vendor management program to review and validate that those security controls are in place.
Yeah, very good point. And those new vulnerabilities are combining with other things that have been happening in the last couple of years. You know, we've got the big push to work from home. We had so many organizations that kind of very quickly had to spin up from allowing, you know, supporting 10 or 20 work from home users to supporting their entire workforce working from home. And so quickly implementing things to allow that, and maybe opening more vulnerabilities because of that. Just a long history of teaching people bad password practices. We'll talk about that a bit later. And then the big thing underlying all of this is cryptocurrency. So most of the breaches we're seeing today are ransomware. And the big driver of that is cryptocurrency. Never before in our history has a bad guy been able to ask for a 6 or 7 figure ransom and get that paid almost immediately and almost anonymously. You know, the cryptocurrency, the ability to just do that, to hold somebody for ransom in that way and not be able to follow the money to find them, has just exploded, that whole industry. That gets us to our first code word. Code word 1 of 6 is 935. If you want to mark that down, 935. So how are attackers doing this? Well, there are a wide array of ways that attackers are getting into system, are getting a foothold, are collecting data, are hiding themselves. There's an industry organization out there called MITRE that kind of maps these and kind of keeps an inventory of which techniques are which attack groups using and things like that. You can see this is just part of the chart where they're mapping out these, and these are the high level ones. It seems very daunting as any organization to say, I have to understand all these things and make sure I have security controls in place for all these things. And there's a little bit of that, but some of it is, if you get the fundamentals right, it breaks a lot of these things.
Yeah, that's a great point right there, Kevin. Just getting those fundamentals. I mean, there's some first principles when it comes to compliance and security, patch management, vulnerability scanning, those asset inventory. There's some fundamentals that are out there that could really mitigate a lot of these. And just knowing what those first principle security controls are, could look at preventing a lot of those threats that we see.
Yeah. And I'll do a couple of examples of attacks here. So a lot of people think, oh, these hackers they're elite hackers. They do really elite hacking things. But really, so many attacks are just the result of stolen passwords and finding passwords and phishing for passwords and things like that. So this example is our penetration test team collects password dumps. If a bad guy breaches an organization, after they're all done with them, they might dump the password list that they stole from their database or something out to the internet. So we collect these, and these are just lists of email addresses and a password they used for something like LinkedIn or Dropbox or things like that. That gets disclosed to the internet, and bad guys have access to that. We have access to that. So here I'm just searching. It's called a grep, searching that list that we have for any email addresses containing ansons.com. And you can see when I do that, it just starts spitting out to the screen, and I'll pause it here, spitting out to screen like email address and then password pairs. So Jay at ladyandsons.com used Heather1 sometime for their password in somewhere. If I let this run, this would run for about 5 minutes, just spitting out one password after another. There's millions of disclosed passwords out there. And, if they used it here, they might use it or a similar one somewhere else. That's just one of the many ways that the bad guys are kind of getting that foothold, getting a first login into your environment.
Yeah, and I remember a story once that I was sitting out there providing consulting services, and a CFO came in and said, somebody knows my Wi-Fi password. And that's how they're generating those blackmail emails, right? That to say, hey, we know your password, blah, blah, blah. We're going to release this, web footage that we have of you. And he came in, somebody knows my Wi-Fi password. It's like, no, you probably use that same Wi-Fi password elsewhere. And they just got it from one of those lists and built the blackmail email off of that. So, and that's exactly what it was. He's like, yeah, I do use that everywhere. So, that's again why you want to use unique passwords, because some site that wasn't protected has that password, and then they can do a replay attack somewhere else. So, use unique passwords everywhere if you can.
Yep. Yeah. And even with passwords, like we're seeing more and more organizations finally getting on board with the multi-factor authentication train, where, yeah, it's not just your user ID and password, but a code on your phone or a prompt on your phone or something like that. But attackers know that, and they're finding really creative ways to get around that too. And we're seeing a lot more of this. Obvious ones like social engineering attacks to target second factor codes. The common thing there is, calling somebody up and saying, hey, this is your bank. We think there's a problem with your account. I'm going to send you a code to your phone. Read it off to me so I can confirm you are who you say you are. And then they try to log in as you because they've stolen your password. That sends a code to your phone, and you've just read that code off to the bad guy on the phone. So some of those multi-factor authentication processes, they're complex enough that it's pretty easy to do a trick like that to trick people. And even beyond that, we're seeing kind of this apathy issue where all day long you're getting multi-factor authentication prompts on your phone. Was that you trying to log in? Yes. Was that you trying to log in? Yes. And bad guys are just repeatedly trying to log in, hoping someone will click yes and not realize it wasn't them. And it works. People are doing that. And then we do see some of this lead hack, and it's called a man in the middle attack. I was just working with a bank this week who the bad guys had set up a login page that looked identically to the bank's login page, but the domain name was different. Instead of bankname.com, it was bankname.info. And when the bad guy went to log into that fake login page, that login page collected the information and then sent it onto the real login page, including the multi-factor authentication token. So the bad guy was man in the middle, watching that traffic, and was able to basically be in the middle of that logged in banking session. And from there, they were, setting up connections to outside banks to transfer money, or doing bill pay things, or a lot of these, kind of Venmo or things like that you even transfer money even more quickly if that's integrated. So yeah, a lot of scary ways that they're just breaking into those type of, getting bypast that authentication protection.
Yeah, multi-factor authentication was such a pain in the past, carrying around a secure ID token or, something you had to carry around with you. Now that everybody has a cell phone and you're just kind of using that as a method. But I really like what you brought up with, and I saw another client put this in place with, multi-factor having another challenge that was displayed on the screen. Like, here's the number and you have to select that number on your phone. So you're there at the terminal, you see what the screen, when you go to log in, what the number is, and then you validate it on your multi-factor method, whether that's your phone or not. And I kind of really like that, because if you are using multi-factor, and it pops up there and you're like, oh, it must be this re-signing back in, and you hit yes. No, it could be somebody else or attacker trying to log in and then engaging your multi-factor token. So I like that kind of challenge that they're starting to embed into the soft tokens on the phones and that. So to validate that you're actually at the screen and you see the number and you validate that number. It's nice.
Yeah. And then, like I said, ransomware is the big thing going on right now. And you kind of know some of the impacts of that. If you might be thinking about ransomware back in the day, which was they infect one computer and encrypt that one computer. That's not how it works nowadays. Nowadays, they get on your network, they hunt around for days or weeks, collecting administrative passwords, finding your backup systems and collecting the passwords for those, figuring out what's critical. And then all of a sudden on a Friday or a Saturday or a holiday or something like that, they're going to click the button and delete everything delete your backups if they can, and encrypt everything that's critical. And then they start reaching out with these ransom demands saying, hey, we'll give you the keys to decrypt it if you pay our ransom. We'll keep from posting it on our shaming site if you pay the ransom. This screenshot here is a shaming site where the Maze group posts, hey, we just broke into this company. Here's a small snippet of the data we stole. If they don't pay the ransom, we're going to post the rest of it here. And one of the things we're seeing growing is kind of an ongoing harassment. It used to be the attacker would just kind of email you and say, or, have this message left for you, say, contact us for the codes. Well, nowadays, after they've encrypted your system, they're calling your CFO, your other executives, and saying, hey, this is the bad guy. Why aren't you talking to us? We're going to do bad things. And so it's just putting the pressure on, making it even more painful when you have these types of attacks.
Yeah, the days of, hackers being cyberpunks is just not the thing, causing disruption or reputational damage is not what they're looking for. It's all about collecting that intellectual property that the universities or, higher ed might have, and then, either repackaging that, selling it to other countries, getting that kind of foothold into, what do we have for materials that are out there? What are we training our, within our universities, gathering that, and then, like you said, holding that stuff hostage. It's no longer just, getting on something and trying to disrupt service or that. Really sitting there digging around, getting data for months on end until they feel like, okay, we got enough. Now let's, on top of it, kind of like the cherry on top, let's also get some cash while we're in here and do that kind of ransomware attack.
And I did want to have something about here about credit card breaches as well. They're not as common as these ransomware attacks, but definitely higher ed is a big target here. You guys probably already know how much of a burden a kind of credit card security and credit card compliance can be, because you guys take credit cards in so many different ways. You know, you're like at desks, you're trying to take them at the sporting events, you're trying to take them at recruitment events where your people are mobile. So you kind of have every type of credit card acceptance that, you know, other merchants don't have to deal with as many problems with that. And we are seeing credit card breaches somewhat commonly today. Not so common anymore, the types of breaches at the point of sale system, you know, at the cash register, things like that. And most of that went away when everybody upgraded their card readers to have them chip enabled and things like that. But we are still seeing a lot of credit card fraud on websites, on the e-commerce websites. Usually now they're using this kind of client-side card skimming techniques where they're actually collecting the card numbers from the browser before it's even sent to the bank or to the school or whatever. There's a number of tactics that can be used to do that, and they're very creative with it. Like again, kind of the example here I've got on the screen of the source code, the second to the last line that starts with @preg replace, that one line of code gives the attacker a fully featured like web shell backdoor into this web server. They just plop that one line of code into any web page on the server, and they can send a specially crafted request to that web page, and it's going to let them add files to the server, read files off the server, you know, basically have control of the server because it's a, you know, fully functional backdoor. And it's so easy to hide and so really hard to find.
Yeah, and like you said, there's so many channels that they have there on campus. You know, whether it's, you know, sporting events, like you said, or drama events, anything like that. And a lot of times there's a lot of volunteers taking those credit cards, right? So they haven't been educated on, you know, cardholder data theft or anything like that. And so maybe something there is to kind of look at putting together something to say, hey, you know, we're taking credit card payments, just kind of educating your volunteers on taking those payments and how they handle those credit cards securely in that, you know, and all those different payment channels that you might be taking those in.
Our second code word here is 311. So mark that down. So yeah, pretty scary. We're talking about a lot of challenging advanced tactics and techniques. The good news, as we said early on, is if you do the basics well, you're actually pretty well ahead of a lot of this. And I guess before we jump into that, we do have a poll question here to get a sense for kind of how prepared maybe you guys feel like you are. So the question is, have you practiced your incident response plan with a tabletop exercise? You should get a pop-up on your screen with that query. And if people aren't familiar with the tabletop exercise, that's where you get kind of your IT folks and your security folks and leadership together and kind of pretend you've had an incident and kind of walk through what would we do at each step. Are we prepared? Is that data available? All that kind of stuff. And I think we'll just wait another second here because we'll get the responses once people have submitted. All right. I think you can see those responses on your screen. So we've got about a third yes, about a third no, and about a third that are unsure. So that's interesting. Yeah, definitely a pretty important exercise to do, especially nowadays with, you know, it's especially looking at ransomware is probably the first one you should do if you're going to do one, because there's so many aspects to ransomware in terms of you got to do a recovery of data, you've got potential leak of information to the public, you've got just systems offline, all that kind of stuff. So
Kevin, we did have one question come into chat that I wanted to pose to you guys real quick here. The question is, do you see, you know, companies or institutions paying the ransomware demands to hackers or using their backups to restore the systems no matter how long it takes?
That's a great question. So what we're seeing is a lot of it depends on whether the organization had cyber liability insurance. If they didn't have insurance, they're almost never paying the ransom. Like we've had some organizations like our backups are encrypted, we can't recover, we're just going to start over from scratch because we don't want to, sometimes it's, we don't have the money to pay that ransom. We don't have insurance. Sometimes it's, even if we could, we're not going to give that money to terrorists overseas. So there's that. The flip side of that is when organizations have cyber liability insurance, the insurance companies have kind of created a problem for themselves in that, say you've got a $25,000 deductible on your cyber liability policy. Well, if you've just had a ransomware breach, by the time you've hired an attorney to figure out your public notifications, hired an investigation firm to figure out how the breach happened, and hired, you know, an IT firm to help you recover, you've spent that $25,000. So now it's no skin off your nose whether or not you pay the ransom. Might as well pay the ransom. Even if you can recover from backup, some organizations are still paying the ransom just for the peace of mind that the attacker is going to give my data back or not disclose it. Like, I don't know if that's much peace of mind. You're going to trust the bad guy to, you know, not hold on to that and do something else evil with it. But yeah, so a lot of ransoms do get paid, and it's a snowball. A $200,000 ransom allows those threat groups to hire a bunch of more people to do a much more ransomware attacks. And yeah, it's just a terrible situation. I know the insurance companies are looking for ways to change that pattern. And we need to change that pattern. But a big thing there is, I think it's the second bullet on this slide. My backups weren't safe from hackers. Again, just a couple weeks ago, I was working with a client. They encrypted my backups, or they deleted my backups. I didn't know they could do that. We have to start our whole company over from scratch, because we can't pay the $1 million ransom. We don't want to anyway. And that's so scary to think that, you know, leaders and IT people aren't thinking about that. They're thinking about, my backups are offsite because they're at the other plant or at the other building or something like that. Yeah, that protects them from a flood, but doesn't protect them from a hacker on the network with your passwords. I wish I'd known MFA was so easy to implement. We work with companies that spend years kind of putting in multi-factor authentication. It's too expensive, it's too complicated. Our employees are going to be annoyed by it. 2 days after they've had a breach, we've got MFA up and running for them. And they're like, well, that was easy and cheap. I wish we'd done that sooner. Antivirus gaps. So they might have been paying for antivirus all along, but when we come in to do the investigation, we're like, yeah, 20% of your computers weren't running antivirus because some process was broken and you weren't monitoring for that. And those were the ones the attackers took advantage of to do this attack. How easy it is to get admin access. So people are surprised. Almost every one of these ransomware attacks, the attackers are using the domain admin, kind of the God account on your network. But it's because Microsoft Windows environments have a lot of weaknesses and default settings and things like that allow a bad guy, once they've got the tiniest foothold, they've got, you know, the account for your time clock that gets them a tiny foothold on the network that lets them find a encrypted password to decrypt, or, you know, find a password cached in memory, or a lot of different ways they can get to these admin passwords that, again, let them start encrypting servers, let them start deleting backups, all that kind of stuff. And at the end of it, that they didn't have hardly any logs. Default Windows log settings, if you didn't change those, you might only have 2 days worth of what we call security event logs, who logged in when from where. So when they come to us, you know, say, hey, it looks like the bad guy's been in our network for a week or two. Can you tell us how they got in, where they got in? How do we secure ourselves? We'll be like, no, your logs only go back 2 days. So yeah, a lot of easy things to fix that you wish you'd known, you know, 2 weeks ago rather than today after the attack. And so here's the doing the basics well. Your IT team should have these things in place today because they're the basics. Multi-factor authentication, we've talked about that, but also for email, multi-factor authentication on every mailbox. We're seeing so many financial, like electronic payment fraud things happening that all originate from mailbox takeover and manipulating messages for your accounts payable, your accounts receivable. You guys are familiar with that techniques, but we still see them constantly today. And those shouldn't be happening anymore. People should have MFA, and your people who make payments or receive payments should not be falling for that kind of stuff. Get your antivirus everywhere and turn on the bells and whistles. You know, call them bells and whistles, but they're advanced features like host intrusion prevention and firewalling and threat detection and things like that. Those things work to try and help stop the bad guy where the traditional antivirus doesn't. Patch management, obvious, but extending it to your firewalls. You might not be thinking about that. How frequently are we patching our firewalls? The next thing here, the bullet on passphrases. So I'm going to go to my little diagram here on the bottom. We have been teaching people bad passwords for years and years and years. We've been telling them 8 characters with all these complex characters is a good, strong password. And it's a terrible password. I've got an example here. It's the word Spartans in Leet speak, where we've changed some letters to numbers and characters. But if that's your password, it's hard to remember. You know, which was it? Was the S a 5? Where was the @ symbol? Things like that. But it's easy for a computer to guess. If I saw that, if I stole that password encrypted on your Windows network today, our $4,000 computer in our office could crack that, decrypt it in 48 hours. And that's how we do it. That's how, when we're doing a pen test, we break into networks. We grab that encrypted password and we throw it at our server. And if it's 8 characters long, we'll have that password in 48 hours. So we're trying to teach people passphrases. What's different about a passphrase? It's not just that it's long, but that's a big part of it. But it's, you know, easy to remember. Nobody's writing it down. Nobody's reusing it. But the length makes it hard for a computer to guess. You know, we go from 48 hours to thousands of years. And we're telling people it's easier for your employees. Don't make them think about the length. Make them think about, we're not going to require all these complexity things. You can see that passphrase is all lowercase. There's no symbols, no numbers, no uppercase. We don't require that. It just needs to be long, and think of a series of words that you're going to remember. You can all picture a purple snail with wings wearing a 10-gallon hat, and I ask you a year what that password was, and you'll probably remember what it was. System hardening, network segmentation, those are things that help to, again, prevent that attacker who gets a tiny foothold from escalating to the admin account. And then one you might not even know about, but a real easy and cheap one is something called protective DNS. So DNS is a domain name system. It's a protocol that, you know, if you type in google.com, it's the protocol that turns google.com into that IP address or number that it uses to find Google on the internet. If you're just using Google's DNS or a basic DNS from your ISP, that's going to resolve every address you request. There's services out there called protective DNS that won't resolve if it thinks that that site is a bad site. So if it's a phishing site, if it's a malware download site, when you try to look up that site, it's going to respond back, no, that site doesn't exist. And suddenly, if someone tried to phish you or things like that, your computer can't get to that site because this protective DNS blocks it. It's an easy, you know, there's some free services, there's some inexpensive paid source services, and really effective control that, again, so kind of simple that people should have it today. So that's the stuff you guys should be doing already. There's stuff that your IT folks should have on their radar. You should have heard about some of these to know that they're talking about them. The first one is endpoint detection and response applications. So this is like the next step up from firewall or from antivirus. Names you might have heard are SentinelOne, Cobalt Strike, Cylance, things like that. But basically, it not only protects the computer from viruses, but it basically tries to watch what's going on the computer, on that network locally to it. And if it sees things that look like they might be bad guy activities, it's going to tell the rest of the network about it, you know, get you kind of more effective catching ransomware attacks and things like that earlier. Protected backups, I've harped on this a bit, but you need to get those backups offline on like tapes where the attacker can't just delete them, or even better, like in a cloud or behind some MFA. We're seeing a lot of people moving to cloud backups. That's seems to be a really great way to easily protect yourself from, you know, deleted backups during ransomware attacks. Filtering your outbound traffic. I know this is especially difficult in higher ed organizations where you want an open posture. You don't want to block people from going wherever they want to go, but there's at least some categories in your web filter. You know, certainly hacking sites you want to block. There's also an uncategorized category. You block that at least from your business network. Should prevent people from getting to some phishing sites and things like that, and just denying other protocols where you can.
Kevin, couple of questions, or just one comment, one question, I guess here. One of the participants said they had a ransomware attack. Encryption they used was pretty smart. When they tried to restore from the backup, it knew to immediately encrypt the backup. They ended up paying the ransomware in that case. They said as they didn't have any further backup there. So I think that just speaks to the, the point on the, previous slide there too, in terms of the security of those backups and looking at that part of it as well. And then there was another question, and I had this question as well, as you talked about the, moving maybe away from the traditional, complex passwords to the passphrases there. I know right now we're seeing a lot of different kind of, we all have too many passwords, right? That's a common, recurring theme there. So these password management tools or apps or things that are out there, the LastPasses of the world, Keeper, I know some of the bigger ones that are out there, but what are your thoughts on, or do you have any thoughts on utilizing that type of tool for managing those things? And if so, are there any that have kind of caught up with what you're seeing, the move towards the passphrase versus the the auto-generated passwords that they're coming up with?
Ken, do you have thoughts on password managers?
I think they're great. If you can, have a validated, if you're going through and doing your due diligence and making sure it's just not something you're downloading from an app store, like Google App Store. And, kind of a funny thing, this is out of the box a little bit, but one thing that I've done, and this has kind of nothing to do with password management there, I just kind of change my password every time. I forget what it is, so I just make some random password and then use the forgot my password. And so I have different passwords everywhere because I have my phone and it emails me, and then I change the password and log in. So a lot of the banking sites and those, so I wouldn't use that for, a regular news blog site or anything, but anything that's protecting my personal stuff, I actually don't know what the password is to that. And, I make a big long one and I use the Find My Password. If I had if you're going to your Blue Cross Blue Shields, your medical records and those things, why use a common password for that when you only log into it maybe once or twice a year? And I just put a really long password in there and then uses the forget my password thing. So that's kind of a tip from, somebody that, out of the box type of deal.
Quick last slide here on some other things that should be on your radar. How do we get those filter controls at home users? Be thinking about that. Getting at least 6 months of history in your logs. Related to logs, so a SIM is a log management solution. Managed security services provider is typically an organization that will provide that SIM and people to monitor it and tell you if your logs are showing bad things happening. So if you don't have that, it should at least be on the radar and the roadmap today. And then periodic testing, even if you feel like you've got the key things in place, patching, antivirus, hardening, passwords, you don't know what the gaps are unless you're testing for that with things like vulnerability scanning, penetration testing, and other assessments. Our next code word is 752. And with that, I will turn it over to Ken to dive into risk management.
Yeah, we've been talking a lot about, prevention of breaches and then response and kind of recovery. But, one of the biggest weaknesses is risk management afterwards. And I kind of want to get into that a little bit and identifying those root causes in that. So looking at cyber risk management, and, a question here for a poll is, is the audience here seeing more requirements from, your cyber insurance companies and regulatory bodies, about incident response? Do you guys have an incident response plan? Have you done the tabletop exercising? Are you seeing more requests that these things are in place or not from your insurance carriers and any other kind of regulations that you guys might have? I give a chance for people to answer this. I'm thinking I can guess the answer on it, but yes. Yep. So a lot there, majority in the yes and then the unsure. Really what we're seeing in the industry is that insurance carriers like, Kevin mentioned, they're sick of paying kind of the ransomware and that kind of stuff. And they're working with companies like Sikich to develop risk management criteria Almost like when you get your car insurance or home insurance, is the fire station down the road? Is there, an alarm system on the house and different premiums in that? So, these regulatory bodies and insurance carriers are getting smarter for cybersecurity, and they're requiring that you are prepared and you can identify an incident, respond to it, and recover from an incident to reduce that liability on them. So, you're going to see more and more of that within the industry. This next slide here. So what I wanted to cover is after a breach or any other kind of incident that you might have is really doing a post-breach risk assessment on that. Taking a look and documenting what was the risk and, what could we put in place to prevent that risk going forward. We're so used to kind of, dealing with the breach at the time and then recovering and kind of just wiping our brow to say, oh, we made it through it. We're there. We're back up and running to go back and look at what caused the breach in the first place. An example here and kind of what, we're talking about those first principle controls that you can have in place. And Kevin mentioned it in one of his slides there. This example here is failure to maintain hardening standards. So, we initially put the systems out there and the assets and we harden them to what we think at the time, but we don't go back and update our images and the root cause for a potential breach could be, hey, we just haven't done patch management, or we keep on repopulating the same vulnerability out to new assets because we haven't updated our hardening standards. And we're just following the same old checklist that we did 5 years ago. And those vulnerabilities are current today now. The other thing of looking at this is setting priorities too. So the organization has a lot of different solutions and systems that they're putting in place and supporting, and really doing the risk analysis and saying it was this high, medium, or low risk, and prioritizing that in with your other projects, so we can prevent this going forward is important. That's why you want to do that kind of risk analysis that we'll talk about. So determining the root cause, Kevin was talking a few of them there, but just, kind of software bugs. I talk about insider threats with, the volunteers, taking down credit cards, and they could be, taking down credit card numbers as they're taking in those payments, misconfigured systems, just going through social media, social engineering. Phishing is a huge one, right? That's why lately we've been doing a lot of phishing campaigns because, that's, again, attacking your weakest link, which is sometimes your personnel. Just lack of encryption. These are all different kind of root causes and threats that could lead to, a breach, and the weak passwords and that. And these are the types of things that you want to kind of identify. And do we have, are these the threats that cause the breach? And then what mitigating controls can we put in place? So one other thing is to look at is the impact after a breach, right? Again, we're moving through, we recovered, we're up, what was the impact, and even predicting a future breach after we go through kind of identifying the root cause. Okay, we made it through, there was no impact at this time, but possibly if this happens again, if the likelihood of the threat compromising a vulnerability that we identified, what would be the impact to your organization? And really, as we go through that kind of risk criteria, defining what's acceptable to the organization and mapping that back to, if a threat was to compromise this vulnerability, would it lead to a large financial loss? Would it cause reputational damage or lead to regulatory fines, or maybe just interrupt our business? Kind of setting those thresholds within a risk criteria matrix. So when you're going through, you could say, I think the likelihood of somebody attacking our website could possibly happen today. And if it was, here would be the impact. And kind of simple principles of risk is likelihood times impact. And that's how you would prioritize the kind of remediation efforts and the protection solution for that. So really should kind of look at building an impact table and seeing how certain threats could impact your organization. Like I said, risk is likelihood times threat times impact. And you can kind of see how using that methodology here, how you can prioritize. I was out there in the industry, you might see a 3x3 type of heat map. What we've seen is 5x5. It gives you kind of a granular, more, you can prioritize. You're not lumping a lot of things into medium or high. You can have severe, high, medium, low, and then low risk. And building this kind of heat matrix will let you kind of prioritize, like I said, the remediation efforts. And it's very important to assess the safeguards that you put in place to protect against that particular threat or risk that you identify. And so it's not just about, hey, we identified this risk and we know we should remediate it, but we haven't built any remediation plans for it. You know, once you identify something, an easy task is to go through and kind of set, all right, what's the effort for the remediation for this? High level, what would be the plan? Let's add this to a project. Let's add some start dates, end dates, and it's very important to kind of put who's going to be the owner of this going forward. And if you set up your risk register, you kind of see how I had the first half of identifying the risk. The second half would be in the spreadsheet. All right, now that we've identified a risk, here's the recommended remediation plan and our project going forward for remediating it.
Ken, what I really like about this approach too is I see so many of our breaches where the IT staff beforehand were worried about the wrong thing, putting time and energy and dollars towards the wrong thing. They're like, you know, we're worried about wireless attacks. So we had an audit of our wireless and we, you know, upgraded our wireless and all this kind of stuff. And the attackers aren't, you know, driving up to your building and connecting to your wireless. They're coming from Russia over the internet. And so, yeah, kind of doing this type of analysis from what I've seen would definitely help guide your IT staff more towards what are the real risks versus maybe the misconceptions they might have.
Yeah, I'm building this out too. You know, a lot of times after a forensics project or, you know, after a breach, there's a report that's generated in a PDF. And then that report gets lost and buried in some file somewhere, right? If you can put together a risk register and kind of go through and document the post risk, you know, post breach in there and what the root causes were, build a remediation plan. It's more of a living document than just a report that gets lost in a file system. So then afterwards, you know, okay, now we put in the control, we got our safeguard in place, but how do we make sure that that safeguard doesn't fall out of compliance or, you know, become weak again? Like I said, the hardening standard, as you look through these examples, you know, I said, all right, we had we're not keeping up with our hardening standards. Recommendation is to build new hardening standards against the industry, but we should have a measure in place to kind of go through and update those standards, right? And so here, building a measure and a playbook of what you should do daily, weekly, monthly, you know, bi-monthly maybe, or every 6 months or annually, putting together that run book of critical measures, access review, badge access review, firewalls reviews, you know, building some kind of playbook throughout the year to check and validate that, you know, the controls that you put in place to mitigate those risks are running effectively. And just, this is like, you know, just a quick little measure to say, all right, we're going to pull a random selection of our endpoints, like 10% of them. We're going to look through our building guide and we're going to make sure that they're meeting the building guide. And we're going to validate these certain things, that the encryption is in place and that it's part of the inventory. And then, you know, the output would be a spreadsheet of the systems, and then keeping that kind of as evidence for the auditor that you've done a measure, you've checked that all your endpoints have been identified and they're part of asset inventory. So a quick little measure, putting together a run book. We call this the Information Security Assurance Program, because what we're doing is we're ensuring that these controls are in place throughout the year. It's kind of a new role. The Information Security Assurance Officer is kind of something that we've titled, that just goes and spot checks that, you know, IT and other processes are running effectively. So looking at the managing the impact and maintaining ongoing protection, you know, it's critical to have a risk management program. And again, this includes, you know, that risk management program should be doing that investigation after a breach. What's the origin of the breach? You know, being able to do a rapid assessment and addressing the impact of a data breach. You know, how does this going to impact us on that chart that we put together? You know, evaluating what business operations could be, you know, and the reputational damage could happen, and consistently like reviewing and updating the safeguards that you have in place. This should all be part of a risk management program for ongoing protection.
Yeah, and that's the last of our prepared content. It looks like we've got some time here for questions. Anthony, do we have any other questions that have come in or you've come across?
I am looking at that right now, Kevin. Give me 1 second here. In terms of, let's see here, we're just double checking everything here. While we're waiting for folks to maybe enter in questions on that, Kevin, one of the questions we had was, how do I deal with departments that are interested in buying and managing computers and softwares kind of outside of the regular, outside of IT?
Okay, yeah, we call that end user computing, and we do see a lot of that in higher education. You've got your science department that's got a grant and bought a bunch of computers and want to put it on the network, and yeah, that's a difficult challenge. The key recommendations we have there are things like segmenting the network. So if they want something that they have complete control over, they need a network segment that's not part of the school network, that they can't impact you, things like that. Otherwise, if it's got to be part of the school network, we typically say, like, build a security standard, and it applies to things that IT deploys, and it applies to anything else anybody else deploys that also goes on the network. It needs to have this antivirus or EDR. It needs to be patched in this way, and make sure there's controls in place that those other systems at least meet that baseline standard for securing and monitoring them. Can be pretty successful with that.
Yeah, let me give an example real quick too. This is kind of the opposite of that, actually, that we just worked through with a client for a university where we had, remote classes, right? And the professor, had an issue with multi-factor and trying to log in time to get to the classes and that type of thing. And this was an agricultural class, which was, they, hired this professor because he's specifically, he is the number one guy they can go to for this, right? So, the solution there was to actually build a VPN network to his location and issue him a corporate asset, a university asset. And so that way he had a direct VPN in, and it was a managed asset part of the network. They just extended it out to, his location. And that, again, we're protecting it now, we're monitoring it, we have our endpoint management on it. So, instead of eliminating the, forcing him to use the multi-factor authentication, it's about coming up with the right safeguard to meet the business objective, right? And that, kind of was a different approach than what they were thinking. They were forcing him to have multi-factor authentication and try to roll him into something that was actually impacting their business, right? Impacting their classes, because he wasn't able to get to classes on time and that between different things. So, coming up with that right safeguard and then, having that management. So kind of the opposite, where like they were using a personal device, but let's issue him a university device, but eliminate this other pain that he has of logging in and connect, and let's have a managed VPN back to his location.
The definition of a win-win there, right? It's
right.
So excellent. Well, Ken, Kevin, thank you both so much for participating and presenting as part of our forum for this. As always, a ton of information on the cyber side and kind of what our CFOs and our group can be looking at as part of their process for that. So thank you again. Contact information for Kevin and Ken is in the materials for you there. So should you have any follow-up questions, feel free to reach out. I know both of these guys are happy to respond and address anything that does come up question-wise after the fact on that. So I'm going to go ahead and pass things over to Jill Boyle to get things kicked off.
All right. Good morning, everybody. Thanks, Anthony. Now that we have scared you about ransom attacks and cybersecurity breaches, we are going to talk about something maybe less scary, the IRS. So talking today about unrelated business income, and then a little bit of additional bonus material at the end, talking about some foreign reporting. So today with us, I am Jill Boyle. I'm the director of our not-for-profit and higher ed services area. So I focus specifically on the tax side, work with all of our 990s across the firm. So all of our higher ed, including, all of our other not-for-profit organizations as well. And am able to kind of compare and contrast and offer some, disclosure suggestions and things like that. As you all know, there's a lot of sort of gray area as we're presenting, or as we're preparing Form 990. So I lead a team here of people who work specifically in this area. Heather Boniface is a tax manager who is one of the people helping me in that area. For those clients on the call, you may recognize her if you've worked with her, as she does a lot of the higher ed returns with me as well. And then Leslie Keller is going to come on at the end of our presentation. She is a director in our international tax services area. And she's going to talk to us a little bit about some of the foreign reporting that we've seen coming up quite frequently, specifically in our higher ed clients. So wanted to cover a few basics there. Disclosure slide. So our agenda for today, we understand that this is a pretty diverse audience with a lot of different experience in the unrelated business income area. So we always sort of want to start with, let's go back to the basics. Let's cover some, misconceptions, things like that. Let's start with the beginning, because quite honestly, you can dig into some of these very specific topics on a very, very detailed level, but it's often really just specific to each situation. So coming back to sort of the basics and understanding some of that is where we begin the unrelated business income conversation almost every time. So we're going to first talk about some common misconceptions, probably just for some people who might be newer to unrelated business income and what that might be. And then the 3-part test that really is the starting point for every time we are considering whether something might be taxable as unrelated business income. We're going to get into some detail on that. And it's just a good reminder really for every organization who might be subject. And then some items that are specifically excluded, we always want to talk about that too, because that's the easiest answer, right? What can I take off the table immediately as I start looking at my revenue sources? So we're going to put that in there as a reminder. I'm going to talk a little bit about qualified sponsorship versus advertising, just because, of course, with what you all do in the higher ed space, this is comes up pretty frequently. So I'm going to cover a little bit of that. Again, just reminding you of some basics. Rental income, another thing that comes up frequently here. We're going to talk a little bit about that. And then alternative investments, for those of you that have some alternative investments with your investment advisors, we want to always cover that and offer some reminders there. And then, as I mentioned, foreign activity and reporting at the end with Leslie. So first of all, let's talk about some misconceptions in this area. So unrelated business income, what do I sometimes hear? Well, we're tax exempt, so none of our income is ever taxable. Not true. Not true for higher ed, whether you're a public university or a private institution or a foundation. Really, all of you are subject to unrelated business income. That doesn't mean you have any, but that means you could, and that would be filing a Form 990T. So the next thing I hear is, well, unrelated business income is a bad thing. It raises red flags. I don't want to have any. Let's avoid that. I don't really think that's true. You can generate those funds, and in some cases, really beneficial to your organization to think creatively about how you can generate additional revenue. And you might have access to something you wouldn't otherwise by having unrelated business income. It just can't be substantial to what you do as an organization. And then we have to report it, right? So we have to file that 990T. That doesn't mean that you have to pay a whole bunch of tax necessarily. You might have some, and that's not a bad thing. So it's something that you don't necessarily need to avoid. And then the other one is, it doesn't matter how you use the money, right? So every organization will say, well, I don't have any of that because all the money I earn, I use back into our programs. Of course you do. But the test here is, how was it earned? So how did we earn the income, not how I used the income? So that's just another good reminder. One of the other things that I hear sometimes, well, unrelated business income is black and white determination, right? The IRS has rules and regulations out there. This should be black and white. Not at all. Almost the entire process for determining this is pretty gray. There might be some black and white. It's mostly gray. And then lastly, UBI to one organization is not UBI to all. It's really a case-by-case basis. It could be one word in a contract. It could be a really small situation that's different, that can make this different for each organization. And Heather's going to talk a little bit about kind of that basic 3-part test that we use.
Hello, as Jill mentioned, I'm a tax manager here at Sikich, and I'm going to get a little bit more into the details of this 3-part test. So this slide in this 3-part test is something I find myself going to every time I get a question on UBI. So this is a great summary to have available as a reference and to use as a starting point when your organization is considering new streams of revenue. So that brings us to the first part of the test, and that's determining if the income is unrelated. So the income must have a substantial relationship to the organization, so that must be causal and important. And the income must contribute importantly to the mission. And this is the mission on your organization's website or on your 990. As Jill mentioned earlier, this is not black and white. This could change from organization to organization depending on what your specific programs are. So if we come to the conclusion that yes, this income is unrelated, then that brings us to the next step. It doesn't automatically make this income taxable. So we go to the second step, which is if this income is a trade or business. So is this revenue stream, service, or product carried on for the production of income? Are you selling this at the fair market value or to make a profit or at a loss to give someone a benefit of this? And then is there a business plan in place with a profit motive? So are you competing in a space with for-profit businesses? Or again, are you offering this at a discount to your members as a benefit? So if we have yes to the first two, then we go on to the third test, because as the slide says, you must meet all 3 to be unrelated business taxable income. So the last step here is that activity or product regularly carried on or sold? So this has to do with the frequency and continuity of that service or product. And a note here is that it does not need to be going on for the entire year. It could be seasonal and still be considered regularly carried on. So it's just something that, again, can be different in different situations depending on how the activity is run. So we have more details on all 3 of these in the slides to come from Jill.
But first of all, we have code word 4 of 6, and someone is trying to bring us bad luck. The code word is 666. So hopefully we don't find any truth in that.
I said that's ominous.
Right. I'm hoping these were randomly generated.
Yes.
Again, so code word 4 of 6, 666. Okay, so now, as we mentioned, we're going to go into some detail in those kind of 3 steps that Heather mentioned. So this is the biggest one, related, right? So what can I call related so that it's not unrelated business income? This is the one we probably, especially in the higher ed area, I would say is used the most, right? It might be the most flexible here, in my opinion, to say that a lot of what we're doing could be related to our mission. So again, the fact that the funds are raised to use to further the mission, that's not the test. It's how were they raised? How did we earn that revenue? So it's always important to remember that here. So the first thing to think about here is there an educational purpose, right? This is the one where I think you can be quite broad, and a lot of your mission statements definitely will say something about education. But it's worth visiting that from the very beginning to say, if this isn't unrelated, I don't even have to think about the rest of the test. So is there an educational purpose? Are students involved? So obviously those two sort of go hand in hand, but if you're involving students in something and you can sell that it is part of their education or something like that, that would be another way that we would say, well, this is actually not unrelated to our mission. The thing I wanted to point out here, review your mission statement. So what are you saying that your mission is? What do your programs say on part 3 of your Form 990 if you file one? What are you saying there that we do as a program? Could we change that to maybe include something that we've now added that's a kind of a big revenue generator for us? Maybe you can put some detail in one of those about this program. So those can be updated. You can always update those pieces to maybe make something fit a little bit better. So a couple of examples here. I have one just on the kind of the educational purpose. So we're trying to kind of come up with some things our clients have asked us over the years. So one would be, so, a company like Sikich might call up one of our higher ed clients and say, hey, you have a really cool campus. We would love to host something in your new space or something like that. We are going to have a training for our internal people. We're going to have a full day of tax training, which I know sounds incredibly fun, but we do them. So we're going to come on campus and we'd like to use your space. We're going to rent tables, chairs, some IV or AV equipment, things like that. So if you're looking at it specifically from this test, I would say, okay, they're coming on campus for an educational event. I think we can probably call that related to our purpose, right? Alternatively, if Sikich says, we love your space, we're going to have our holiday party on campus using the same. We're going to rent a bunch of things, use your food service, all of that. I would say that probably is not related because now we've lost that educational purpose. We're coming there for a social event. So you can get really that level of detail as you're going through this test. And I'm sure you're thinking, my God, I can't possibly do that on every single revenue stream, but it's just an example. I think Heather had one as well.
Yes, so we had a local college that had some land, and so they had the space, and they decided to start running a golf course. At first glance, it would seem like this is completely unrelated business income, but then as we started to ask more questions about how the golf course would be run, it turned out the school had a very large turf and landscaping program. So running a golf course gave the school a hands-on opportunity for their students to learn and further that education purpose. And then also in this case, the business students ended up running the pro shop and other aspects of the golf course. So having that other student involvement furthered the educational purpose. So from this one example, you can see that there's many opportunities to support the organization's mission, especially if there's an educational purpose. So now Jill will provide some more detail on the trade or business aspect.
Okay, so trade or business. Once we've determined something's unrelated, then we need to move to that second step. So is this a trade or business? What was the purpose behind this revenue source? Did we have some meeting? Maybe it was a board of trustees meeting. Maybe it was a meeting with some professors. Why are we doing this revenue source? So are we doing this to make money? Are we doing this because we want to give our students an additional educational exposure, something like that? So again, reading all of this to say, why are we doing this? Anything that you have in your notes or minutes, could be helpful here to you, could also be requested by an IRS agent someday. So anything that you can gather on your side to have in your notes is going to be best, especially if this is saying, we're not trying to make money, we're doing it for some other reason. The other thing that might be in those notes, how are we determining the price of this revenue generating service or source? Are we just saying, here's all the costs of what we think this activity might cost? We're just going to charge to cover that, right? So we're just basically covering our costs with how we might price this, or we're pricing it to make a profit. We are doing a service and we are making money on it, and we are going to price it as such. Looks like a trade or business to me, right? This was put in place to compare to a commercial activity. So it's going to look like a commercial activity. Is there a written business plan? Again, that's something that comes a lot from sort of the for-profit world in a commercial business. The other thing, how many years of losses? If you're just starting up a new revenue source, it's possible that you would have several years of losses, but you probably don't want to have 10 years. And there's got to be sort of another update to your business plan to say, how can we start making money? So those are all things that look like a trade or business. Next, we have regularly carried on. So this is where we say, again, compare it to a commercial activity. How frequently are they doing something like this in the for-profit world? This one's a little bit harder to have as many examples of, but the one we do have out there that I've talked about before in presentations here, if any of you have logged in, is we have this NCAA case. It's one of the only out there because it's expensive to go to trial, but the NCAA apparently can afford it. So they went to court on a case really specifically about regularly carried on, right? So their March Madness basketball tournament happens every year. It's 3 weeks long for just the basketball. But the IRS came to them and said, well, that's not how this works. The prep time that you spend for probably most of the year to prep for that tournament should be included, right? So this, you can't say it's not regularly carried on because you include all that time, and that's very much regularly carried on. Well, in the case, the NCAA at this point has been victorious. The IRS does not like that. But as of now, the NCAA case rests that they don't have to include their prep time. So they're saying that 3-week basketball tournament is not unrelated business income because it's not regularly carried on. So that's a case to always keep in the back of your mind if you get to this third step and are looking for some other reason you might be able to exclude something. Heather had an example on this one.
Yes, so the most common example here is all of your organization's fundraising events. So we actually had this question come through the chat, and this is where the carve out from taxable income comes for those fundraising events. So your organization may not even be thinking of those events as a business endeavor because they're so common. In reality, though, they could be a business endeavor, but because they're not regularly carried on and they only happen once a year, they are not subject to unrelated business taxable income. So it's really looking at that piece as to if it's regularly carried on or if it's only once per year, and then it can be excluded. So now I'll jump into the next slide, and I have some examples of specifically excluded income. So the first 3 bullets there under the excluded list are interest, dividends, and capital gains. These are the things you see very regularly on your investment statements. So all those regular investments are fine. The IRS has a specific exclusion for those types of income. The next one is royalties, but you'll see there it says passive royalties with no services. Should services be provided to receive the royalty, that's not excluded by the IRS. And then the last point there is rental income from real property. The key here is that it says real property. So there's not an exclusion for personal property, but we'll get into details on that later. And then there are some other exceptions. If there's an event that's run by volunteer labor, that's excluded from UBI. A huge one for colleges is that if you're running something for the convenience of members, students, patients, or employees, that's automatically excluded from UBI. So some very common incidences of that are student housing, recreation centers, and cafeterias. There could even be an on-campus coffee shop that is excluded because it's for the benefits of those students and employees. And then going back to what I had said before, if that coffee shop is run by students, it's even further, it becomes related to the organization's mission because those students are running the coffee shop. I will mention that you have to be a little careful with this convenience of students and employees because use of those facilities may be done by the general public as well in some cases, and that general public use may be subject to unrelated business income. So it's something to keep in mind when you are running those services or selling special products. And then the last point here is the sale of donated items, and that's any common thrift store. So you'll see that with those pretty often. So now I'll turn it back over to Jill, and she'll get into the details of sponsorships versus advertising.
All right, so this is one topic that comes up a lot in higher ed, especially with your athletics programs. I think in some of the larger universities, this is probably their major source of unrelated business income. In some of the smaller private schools, we maybe don't see as much of this, but it's always something you're thinking about, right? I'm going to give some high level here. I mean, this could be an entire conversation for an hour, but what I will mention is the IRS website actually has really, really, really useful information on this. So if you ever are thinking about this and you search for qualified sponsorship payments, the IRS site usually is the first one that pops up, and they have a ton of information. So they don't always have a lot of information on unrelated business income, but this is one subject area that they do cover really well. So some of this I've taken, it's covered there, but let's talk a little bit about what, a qualified sponsorship payment would be not unrelated business income. Advertising is unrelated business income. So how do we determine what looks like one versus the other? So what looks like sponsorship that would not be unrelated business income? Logo. I mean, using the logo of a sponsor, thanking them. You can talk about their location and their phone number, and mention them as many times as you want during an event, a sporting event, whatever, and that is always just sort of excluded. It is sponsorship recognition. Providing a link on your website. that one can get a little sticky if it goes directly to a product purchase page, but in most cases, just putting that link on your website, not going to be an issue. Mentioning even slogans or descriptions of the products, you know, ABC company provides construction services. Thank you for sponsoring. You can say something like that. Their products could be on display. And the flip side of this, from the for-profit business perspective, so ABC Contracting Company, it doesn't necessarily matter if they are deducting that as marketing expense or as a qualified or as a charitable contribution. Obviously, in their case, they probably want to take it more of a marketing expense. But from our side, that shouldn't sway how we report it on the higher ed books. So the flip side of that is what looks like advertising then. If all of those things are not advertising, what is, right? So qualitative or competitive language. ABC Contracting is better than XYZ. We are endorsing them. We are telling you to go buy them, or their products, go call them. They're cheaper than XYZ. And then really just having that call to action to go buy their products. Distributing discount codes or coupons can also be considered advertising. So again, just thinking through a little bit about what are you giving your sponsors back for what they are paying you as a sponsorship amount. I'm going to go into a little information on what exactly is a qualified sponsorship payment. So that is one that so these things can't be in that, but on a high level of qualified sponsorship payment, you can immediately exclude from unrelated business income if you can prove that what the sponsor is getting back from you is 2% or less of the payment. So if the payment's really large, you have a little bit more flexibility here. But think about, again, this is the part where it gets gray. You need to read your sponsorship agreements. What do they say? What does the person get back? And almost keep some sort of a spreadsheet that says, here's my agreement with ABC Company as a sponsor. Here are all the line items that we're giving them back. And what is that worth? So you don't ever have to value use of their logo, right? So thinking our sponsor is never on there. But what if we gave them advertising, right? So just because you gave them advertising, that doesn't make the entire payment taxable. You can carve that out. But if we said we're going to give them a 30-minute ad at one of our sporting events, and we're calling it advertising, we know that's what they're going to do, then that kind of goes into a taxable bucket. But again, the rest of that payment doesn't have to get pulled there. Designating them as an exclusive provider, that's another one of those. It depends. It could be a bad thing, but if it's passive, that can be okay. And then anything that you're providing them, so tickets, something that you can value, you can't get above that 2%. And then if you're granting exclusive or non-exclusive rights to use your name or logo back to them, that piece doesn't qualify as a sponsorship payment. So that would have to potentially be taxable as well. This can get really confusing. My biggest point here is to make sure you know what you're giving your sponsors for what they're paying for you. And that's a great place to start. From there, you can analyze a little bit further. Rental income is another one of the things we see a lot of, obviously, in this context of higher ed. Again, I'm going to talk a little bit further about this real property. But if all you are renting is real property, it is generally excluded. So in any case where you're giving just use of a building or something like that, the problem is in many cases you're pulling in some other things. So you're not just saying, here's a piece of land to use, or here's a building. You also are including something else. So you might be including personal property. So chairs and tables and podiums and AV equipment and a projector, something like that, a screen. So if that's included, then you have an additional test here. So if 10% or less of it is real property, you're okay. You can exclude the entire thing. If 10 to 50% is personal, then we would carve out what share of that would be unrelated business income. And if it's 50 to 100, then we're UBI, we're in the UBI bucket. So it's important in that case to make sure you understand what you're charging for. So we're charging you this to come and use our space, and know exactly what personal property is included and what % of the rent that is, to kind of go through this check as to whether you were into an unrelated business income space or not. Services, this is the other thing. Are they coming in and they're going to use your food service that you provide? That piece of it is going to say that's taxable. So any of those services you're providing are taxable. So again, make sure you understand how much you're charging for that, because it could potentially be carved out of something and you could still exclude the real property piece. So those are important to know when you're contracting with any of that. And then parking is another one we always want to talk a little bit separately about. So parking lots, garage rental are considered personal property. So if you own parking lots or parking garages, it's considered personal property and taxable. But there's always a but, right? There's always a gray area. So Heather had one example here that came up.
Yes, so we had an organization which owned a parking structure in an urban area. And because it was such a busy spot, the parking lot was sometimes used by students, but some of the time it was used by the general public. So when we're looking for UBI in this case, we first need to look at and see if it's related to the organization's mission or for the benefit of the students and faculty, or if it doesn't pass one of those tests. So in this case, we have to look at the piece from students that's related to the mission and or for the convenience of the student. So that's not UBI. But then this other piece from the general public has potential to be UBI. So after we figure that out, we jump into the second step here, which is the parking lot operated by the organization, or is the parking lot strictly leased to a third party? So to clarify, if the parking structure is leased to a third party, meaning they run all the services and everything provided by the parking lot, that could then be considered real property and not taxable income. However, if the organization is running the parking lot and providing all of those services, then that piece from the general public likely would be categorized unrelated business income and taxable. The most important thing here is just to be really reviewing all of your contracts to look for these little language changes, because just a small change in language could result in UBI. So it's just something to look for going forward. And now Jill will jump into the details on debt financed assets.
Yes, first I see a question that came up about sponsorship, and we exclusively sell Pepsi on campus and receive a commission. I think that probably is happening on all of your campuses, either with Pepsi or Coke, and they want you to be exclusive. So that's the piece that we had carved out about royalties. We kind of consider that like a royalty payment. And we said, you know, they're typically excluded unless there's some type of services. So that's kind of where this falls into. So in most cases, you aren't doing anything to receive that commission and you're very passive in it. So we would call that like a royalty payment that's excluded from UBI in most cases. Again, it depends what your contract says. But in most cases with that, it's like all you do, you kind of just sit back and collect that commission. Pepsi comes in with their trucks, they load all of the soda into your machines, whatever that is. A lot of times you're pretty passive in that one. So there has been some guidance out there that says that can be excluded because of that passive relationship. Okay, the debt financed exception in higher ed, this is something that is a little bit confusing, and we just want to make sure people know to at least think about it, or that it's out there. So under, again, I don't often like to talk in code sections, but this one is important to understand, even just to read up on yourselves. So it's section 514C9. It's a specific carve out for higher ed. And it says that unrelated debt financed income is not taxable to, and we put another section in there. That's kind of the box you check on Schedule A about the fact that you're a school on your 990. That's just where that references to. And then it also could include a supporting organization that's 509A3 supporting organization. That is a specific type of organization to support the schools. In any event, this says there's an exclusion for unrelated debt financed income for those types of entities. So that's why we sort of mentioned that in almost all cases, real property is not going to be taxable. In a different presentation, not geared at higher ed, we would say, except if it's debt financed, right? Then it might pull it back in. Well, in the higher ed case, the debt finance piece does not bring it back in. So that's why sort of as you're looking through those, you know, people coming to rent your space, that's how you can get some of that to not be unrelated business income. It's just real property. So that exception is important to know about. It's very complicated, but just make sure you're sort of aware that it's there. The other piece is the partnerships. If you own an alternative investment in a partnership, which is actually the topic we're talking about in a second, if you own that and your partnership has debt financed income, it is determined by the partnership itself, whether you qualify under this section. It becomes very complex and it gets into partnership rules, which is not an area that I pretend to be an expert in anymore. But there is a possibility that even through a partnership, this could be excluded. In my experience, we never get the right information from the partnership. So that's going to come in on a K1. And if we don't have the proper information, most cases we'll say, let's be conservative and pick it up because we don't know. So that's just, again, something to be mostly aware of. I'm not going to go into too much detail on it other than telling you to, be educated on it. Alternative investments, as I mentioned. So again, this could be a much larger topic. For the purposes of today, I just want to make sure we're all aware of them. We know they're out there. Have a relationship with your investment advisors and make sure that they are aware what some of your alternative investments might cause from a tax reporting standpoint. Make sure you ask that up front when you hear, oh, we changed investment advisors and they're going to switch to a whole different allocation, right? Get in those conversations. Who are we investing with? What are we investing in? You need to understand that because there's some complexity that can come up in the unrelated business income world. So we often would say this is going to show up as part of your audit. Level 3 investments, when they're talking about the valuation, they report at net asset value. That can be a good trigger as to like, wait a second, I heard a presentation one time that said I need to look at this further. Could be a joint venture, a hedge fund, a partnership, an LLC, or a corporation. And we may have additional reporting needed from that. So in most of those situations, you'll see, or many of them, you'll see a K1, and that's generated by the partnership itself and sent to you. And it will determine our unrelated business income. They will provide a statement in there that tells me what is unrelated business income, and we take it. We take that number right from a K1, and that's coming from an outside preparer. So we need to get a copy of that. There could be a situation where you have foreign reporting. So if the partnership then took your money and invested in some foreign investments, that might trigger some reporting. So Leslie's going to talk a little bit about that. If you directly invest in a corporation, you wouldn't get a K1 unless it's an S corporation. So again, this is going to get very complicated very quickly. My main point is to be aware if you have these, ask the questions and know that there's a little bit more digging you might need to do. Also an S corporation, just as an FYI, that income is always unrelated business income. So if you have a donor who gifts you an interest in an S corporation, that is all unrelated business income to you. So just be aware of that. This little tree right here sort of helps us decide, are we waiting for a K1? I heard about this form K1, am I getting one? When do I need this? So it really is, you're only going to get that if the partnership if it's treated as a partnership for US federal tax purposes. We will often request additional information to figure this out with you, but this is just sort of a good guide to have for you. If it's a partnership, yes, you should get a K1. If it's not, well, what is it? So then we have to dig a little further and say, well, is it foreign? Maybe that's why we're not getting a K1. Or is it a US corporation, which doesn't issue those? So this is just sort of a decision tree to help you walk through that if you're new to this, or if your institution is just starting to explore getting into some more of these alternative type investments. This is a good tree to have to help you with that. Code word 5 of 6. I like this one better. 729. So again, code word 5 of 6 today. 729. Okay, then I just have a couple, looks like we'll have time to cover this quickly before I turn it over to Leslie. Couple slides just to talk specifically about the Form 990T. Some of you file it, you're probably really aware of what it looks like, what it's doing. Just wanted to update again, something that changed in 2021, the 22 looks the same, but a lot of us in the higher ed world are still dealing with the 2021 forms because we're always, fiscal years are a year behind. So the 990T looks different. It was updated for good reason. There was some regulations that came out that that now are requiring us to sort of report things in silos. So I can't take my revenue from making widgets and offset a loss from my investment activities, right? So they kind of have to keep our activities in different silos. And that is by 2-digit NAICS codes which if you're unfamiliar with those, you can always just do a Google search quick and they'll come up. But the 990T was updated to give us a separate Schedule A for each one of our silos. Now, for some of our higher ed, you might have 3 or 4. You might have advertising, you might have some personal property rent, and you might have some alternative investments. And the alternative investments, as long as you own less than 2% or don't have any control, are often able to be grouped together. So all of that can be one silo. Those can income and loss can offset each other, which is at least one good thing. But your advertising can never be offset with your investments. So in the higher ed space, I see there can be 3 or 4. There can be 15 different Schedule A's. So again, all depending upon what you're doing at your school. And then in the 990 page 1, if you look at it, is just a summary of all of your additional Schedule A's. So it actually makes some sense, the new design of the form. So it's pretty easy to use in that way. And then there is an e-filing requirement. So if you are a small school and you say, oh, we've never had a 990T before, but I have this one thing I need to put on it, I'll just pull this form online and quick, put in my numbers and get it out the door. You have an e-filing requirement. So obviously if you're using a firm like us, we will take care of that for you. There are some websites that actually the IRS provides that has e-filing for you that can be pretty reasonably priced as well. The last thing I wanted to cover here was talking about net operating losses. So if you've had losses carrying forward on a 990T for years and years and years, there are a couple of special circumstances now that came up as part of the CARES Act. So if you have losses that were pre-2018, those can be offset against any of those silos we just talked about. So those are really good NOLs to have. If they are after that, you have to keep your NOLs in those silos that we just discussed. So your advertising NOL would stay within advertising, can't be used against your investments. So those NOLs stay in those buckets separately. And then we've now got this rule where after 2020, our NOLs are now limited to 80%. So in some cases on the 21 form, you may have losses. Let's say you have $100,000 of taxable unrelated business income on your 2021 990T. And that may be because of your alternative investments or advertising. You came down to taxable income of $100,000. Let's say you have 200,000 of losses that are carrying over from years of losses. We can only use 80% of that to offset. So we can only take 80,000 of that. And this year you would still end up having taxable income of 20,000. So just something to be aware of for prior to, the last couple of years, those losses, like, well, we never have to worry about it there. We can use them forever, not a big deal. Well, now we have this limitation put in place. So just something to be aware of. You could end up owing some tax, which again, isn't the end of the world if you're making money on your unrelated business income activities. So we are going to switch topics a little bit to just go over some foreign reporting with Leslie. So take it away, Leslie.
And so just to start our session, we've got a polling question out there. Which foreign reporting topics have come up the most within your organization? Alternative investment reporting, payments to a non-US person, operations in a foreign country, or international affiliates, or it hasn't come up yet at all? And as you take a few minutes to answer that, just wanted to reintroduce myself again. I'm Leslie Keller. I'm the Director in International Tax Services. I primarily focus on the US reporting of the international activity. And we'll get a few results here before we get on. So it hasn't come up yet, is there, and payments to a non-US person, which definitely is one of the things we probably see most often in this space. So moving on with our foreign reporting, let's talk about some of the items to consider when reviewing foreign reporting obligations for your organization. Does your organization investment portfolio, including alternative investments? This could include those limited partnerships, hedge funds, and perhaps private equity that Jill mentioned earlier. Does your organization have international operations? or a shared arrangement with a foreign university? Do you have international students or faculty on assignment abroad? Each of these items may require additional reporting, and the facts and circumstances of each will determine how that reporting should be addressed. The risks if you fail to properly disclose or report these items can result in an incomplete filing, which would result in no statute of limitations on the filing submitted, and or perhaps penalties for failure to file. The foreign informational reporting penalties start at $10,000 per form per year. So on to the next slide. Some of the most common reportable items that you would be including is a transfer of property or cash offshore to a foreign entity, perhaps through your investment advisor, ownership interest in a foreign entity or fund, financial interest in or signature authority over a financial bank account in a foreign jurisdiction, payments to non-US taxpayers, such as a foreign student or a foreign affiliate. So if you have any of these, then what? Next slide, there is a few of the foreign reporting forms we're going to address that we see most often, and they would also be disclosed generally on your 990. The first is the Form 926 and the Form 8865. So when investing in an alternative type of investment, it's important to analyze the structure and the tax treatment for US tax reporting. Do not let the name of the fund mislead you. It may say limited, which we generally think as a partnership. This detail, generally you need to look at the private placement memorandum of that particular investment to determine how it will be treated and considered for US reporting purposes. It can be considered a corporation or a partnership, and perhaps elections have been made. When the amount that you invest is $100,000 or more into a single foreign entity within a 12-month period, there is a reporting to include with your 990 or 990T. If the structure is determined to be a corporation, the investment made is detailed on a Form 926. If the structure is a partnership, it's a Form 8865. Both forms include specific information on the investment, including the percentage of ownership within that entity. Failure to include the form results in incomplete return, and the statute of limitation never starts. In addition, the penalties may apply and can be as high as $100,000 per form or investment. On to the next slide, the Form FinCEN 114, which is the reporting of a foreign bank account or financial account, and it's commonly referred to as an FBAR. It's required to disclose financial interest in or signature authority over any financial account. This is required when the aggregate value of all those foreign accounts at any time during the calendar year, and again, this is on a calendar year basis, exceeds $10,000 US. Investments in hedge funds, private equity funds generally don't apply. This is a separate filing based on the calendar year, as I mentioned earlier, and it is due on October 15th of the following year. In addition to the organization having a filing requirement, any person within your organization that has the signature authority over that account is also personally required to file this form. This form carries a $10,000 penalty, and the focus of the IRS is this year in 2022 is a compliance campaign initiative. Under 2010, the FATCA regulations, the foreign financial institutions are now reporting back to the IRS, the owners, the US owners of these foreign accounts. So the IRS has a way to match up whether or not you should be filing this form in the first place. And even if the amounts are under the reporting threshold and they aren't reaching that $10,000 requirement, there is a place on the 990 that has a question to indicate whether or not you have a foreign account. So the next slide, we're going to talk about the IRS here and their new reporting. Jill mentioned earlier the K1. Well, the IRS has expanded its focus on international. And so in 2021, they developed this new forms to go with the partnership returns, K2 and K3. These are additional forms and required by certain pass-through entities. The K3 you would receive in addition to the K1 from the partnership type of investment. It's designed to bring clarity and uniformity to the reporting of the international type transactions which occur within the partnership. It's intended to minimize or eliminate the various footnotes or the white paper detail, which is attached to the K1, which in some cases can be a book. These forms will include information that may be required to disclose or report within your return. So please confirm when you receive your K1, whether or not you should have a K3. There is a checkbox that is on the K1 that indicates a K3 has been prepared. And on our next slide, we're going to touch a little bit upon the various payments to non-US taxpayers. This was one of the more common that we do actually see in the higher ed. And this topic alone, we could probably do a whole 1 hour plus session on in itself. But the tax treatment and reporting varies based on the facts and circumstances surrounding each type of payment or award and the person that's receiving it. It will not necessarily be treated the same for each student or each individual recipient. There are special rules that apply to foreign students that are here on a student visa. There are tax treaties between the US and the various foreign countries that may determine whether the tax treatment of a payment to a foreign person and if the US tax is required to be withheld from that payment. In addition, there may be reporting to the IRS for the payment regardless of the tax, regardless if tax is withheld, such as on a form 1042 or 1042S. Sometimes the IRS, just based on the type of payment, is requesting that these forms be filed and the recipient receive their copy. So one example is scholarships. Is it a qualified or non-qualified scholarship? What is the designated use of the scholarship? Is it for tuition or is it for use in other incidental expenses? What's the status of the student's enrollment? Has the student completed either a form W4, W9, which would indicate they are subject to filing US income tax returns and perhaps a US citizen or green card holder? Or are they required to complete a form 8233 or a W8 BEN? These forms are forms you would receive from the recipient of the payment and are maintained on file. And those will help us determine what are the implications of reporting these payments. So the information should obviously be obtained and reviewed prior to making any disbursement or payment to make sure that there's no federal tax withholding obligation from the payment. This withholding obligation can be as high as 30%. So keep in mind, if it's determined after the fact that the federal tax should have been withheld from the payment and remitted to the IRS, it's going to be the liability of your organization making the payment, not the recipient who received the payment. The organization can be subject to penalties and interest in addition to the tax it failed to withhold and remit it. It will be up to you to recover then any tax from the recipient of the payment if you fail to withhold in advance. If you have US staff traveling abroad or on assignments, not only having the proper visas in place is important, but what about the tax implications for that staff in the foreign jurisdiction? Are any of them aware that they may have to file and pay taxes within that foreign country, in addition to having to continue to file their US return? There may be benefits in planning for the assignment in advance to give them the best opportunity to potentially save taxes and minimize their filing. So we provide consulting services and we can review and address the payments as they come around with their particular circumstances. Our last code word is 6 of 6 is 183. It's our last code word today, 183. And lastly, just to wrap up on a few of the items for what we consider best practices all around, and also to help minimize your risk. And Jill, the last slide. We advise that you review the information on alternative investments, identify reporting requirements, maintain a detailed list of all those investments. Make sure you know what is that tax treatment for reporting here in the US. Keep track of the funds you're transferring. And then make sure you're receiving the necessary K1s, K3s. And then identify when you have foreign accounts and should they be reported. And lastly, any advance payments, any payments making to non-US persons, to review those in advance. And I will now turn it over to Anthony for closing.
Thanks so much, Leslie. As we go through and just go through our final slides here and just close out our forum here, just want to take a moment to thank our final speakers for the forum. Jill, Heather, Leslie, thank you all for really in-depth, detailed presentation on this. I think a lot of good information here. When we're talking on tax topics here, obviously, Jill, as you noted in your opening remarks, we have a kind of a wide, wide scope in terms of our audience here. So hopefully some of this information you found to be applicable to your organization on that. If you do have any questions, again, the presenter's contact information is all part of the slide materials for today. So as we wrap things up, first of all, just thank you for your participation, your attention over the last 3 days in this. We hope that you found the forum beneficial and useful in a lot of the topics that we covered here. Wrapping up in terms of the CPE credits here, please make sure that you have entered today's code words or numbers onto the conferences.io site or the mobile app as you're going through and doing that. Once you've completed everything and entered all that information, you can check out of that. You'll keep an eye out for that email survey from Prolera for your CPE credit there. And we are, as we've noted in the chat a couple of times here, working through with our Sikich University team in making sure that we get all of those out for you. So keep an eye out for those over the next few days as well as part of that. So with that, please visit our higher education CFO forum page here. If you do have any additional questions or we didn't answer your questions as part of during the sessions, please, all the contact information is there so you can reach out to them directly with any questions there. Again, thank you, thank you, thank you. I do want to just take a brief moment before we sign off for the forum and give a huge shout out to our team supporting behind the scenes on this, Megan, Kelly, and Rachel, who's not on with us, but appreciate everyone's efforts and putting on our forum here. So again, on the surveys, please complete those, please fill those out. We do take your feedback very seriously and incorporate that into our planning for our future sessions on that. So with that, I wish everyone a great rest of your day. For those of us in the Midwest who are cold, 6 more weeks of winter, apparently what we have to deal with on that. But again, thank you all for your time. Thank you for participating in our CFO forum. Have a great rest of your day. Bye, everyone.